Hello and welcome to this webinar. My name is Stanislav Bernikov and I'm a full-time professional trader with more than 10 years of experience. I will be a host in this webinar where I'm going to share with you some interesting information concerning trading. If you have any questions, feel free to leave them below this video. Enjoy! Let's get started. In this webinar we will talk about self-coaching. Nobody really thinks much about this topic because it seems obvious. All you have to do is to read books, to communicate with fellow traders, and of course to practice, to trade. But I want to say that it is very easy in theory but quite difficult in practice. Once you start learning trading, you go to the web where you face numerous websites, videos explaining trading systems, methods, analytical views, and it is very easy to become confused by this flow of information. Especially it is difficult for beginner traders. In this webinar I will focus on the process of learning, what to focus on, what to avoid, what is useful and what is not so useful. I invite you to listen and make notes if necessary. Most of ideas discussed in this webinar were used for trading either for me or students of my educational groups. Before we start, let's take a quick look at the disclaimer. Please beware of financial risk associated with trading. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. You will have full responsibility for your trading decisions, so we strongly encourage you to test any ideas or concepts using historical backtest or simulator. And before we talk about self-coaching or trader development, we have to answer the question, what is trading? Some would treat trading as a science, trying to capture 100% formalized patterns, trying to predict the market or to describe market action using statistical methods. Some would treat trading as an art, improving their skills in pattern recognition, trying to develop a feel for the market. Both ways to look at the market are not good or bad, and one of the ways to look at trading is to treat it as professional sports. In fact, trading is very similar to many individual sports such as chess, tennis or golf. And first of all, there are many athletes but very few champions, just like in trading. And secondly, trading is all about execution. Knowledge is important, but it's not knowledge that creates outstanding performance. On a logical level you may know many things, but eventually it might not necessarily help you find good trades. So it's not only about knowledge. What about experience? Experience is also important, yet there are too many experienced traders who only can make break-even, but can't produce any profits in the long run. So it is not just experience. So what is trading? It is both art, science and execution. Talent also matters in trading, not just skills combined with knowledge and experience. In a nutshell, trading is a performance-oriented discipline. The good news is that we can grow our skills and become better decision makers, better performers and better traders. And we can become self-coaches to ourselves. This webinar is all about that. Now let's remember distribution of results for retail traders. This graph is not the objective research. It is very approximate estimation based on NFA numbers and my own observations. Around 70% of beginner traders produce loss by the period of 1 year of trading. It may be a loss of just $1, but nevertheless it is a loss. 10% of traders can be winners over a large period of time, yet their equity curve can show significant volatility. This group represents long-term position traders who are capitalizing on long-term trends, which is relatively easier than making profit in day trading. And around 2 or 3% or maybe less can produce profits on consistent basis in day trading. This group can be called expert traders. This statistical distribution is similar to any process, to any performance-oriented competition, and trading is not different. This graph shows how difficult it is to get to an expert level, but that's what we are heading for, because trading for living or trading for wealth building, it is a result of expertise, so we have to become expert traders. We can also become competent traders, and not to lose money in the long run or even earn some in the long run, but to make results greater than average. We would have to get to the point of expertise. I want to distinguish level of expertise from level of competence. How competence differs from expertise? I have my own definition. Competence is considered to be ability to cover your trading costs and to stay in the game. While competent trader knows many traps of the market and can not fall victim of most common trading mistakes, he also is quite disciplined in following trading plan but doesn't necessarily have outstanding strategy. Competent trader knows the market but may not know hidden clues or nuances that eventually make difference between competence and expertise. Expert trader really feels the market, but this feeling is based on very good knowledge of statistics, historical performance of chosen trading instrument. And also, level of expertise allows trader to be one step ahead and react before the market is about to change, not after that. There are two ways to develop in trading. The first is formal education, when you take somebody's trading system or method and just follow the rules. And the second is immersive learning, when you try to develop your own trading method based on your personal strengths, on what you do the best. A formal education seems to be more attractive because you don't have to have deep understanding of the market action. All you have to do is just to execute upon somebody's rules. But you will never become an expert with this approach, following somebody's rules. Being an expert is more than being a good executor. When you are going to be an expert, you are going to make many mistakes, to have a journal, to analyze, to know the fundamentals of the market, to learn many things, and to achieve real market understanding, not just good skills of execution. And finally you come to an expert level. Before starting any self-coaching, you will have to find your place on a learning curve. This video can be viewed by people with very different skills and knowledge, such as beginner traders who are just starting their trading career, or you can be experienced trader with 3 to 5 years of experience, and at the same time you can have no consistency in positive results. I would suggest simple distinction for at least 3 phases. The first is beginner trader, the second is competent trader, and finally is expert trader. For example, one can be an expert in one trading style and the beginner in other one. Later on I will tell you a story about my attempt to become an option seller. For that moment I was already an expert in breakout momentum trading and beginner in options trading. That's a pretty interesting story. And of course, any recommendations for self-coaching will depend on the phase that trader belongs to. Of course, it is pretty much a rough model, but it can be used for the sake of simplicity. For example, beginner trader cannot dig deep into any trading style. It is important to test any ideas, systems, methods until you find something that fits your personality the best. So the motivation for beginner trade is research and trial and error. And it is often counterproductive to learn nuances of some complicated trading methods for this group of traders. The goal of this phase is to test, learn and listen to yourself, and action for this phase is testing, making mistakes, keeping a journal, and trading on a simulator or without any significant risk. Beginner trader can receive education in the form of basic knowledge. He or she doesn't need to learn any complicated things, because first you want to know basic things. First you need to know how the market operates, and then you can go to more complicated things. The commitment of this phase is pretty low, because you drift between trading styles and you cannot concentrate on one single trading style, because you will have to do that until you will find something that works for you. The goal of this phase is to earn experience. That's very important phase, because if you don't have enough experience, If your knowledge is theoretical, you don't know how market works. You don't have the foundation. That is foundation, and you can't really skip this phase. For example, if you date a girl, you first want to spend enough time together to know each other, and only after that you will think about getting married on this girl. So the market is no different. First you have to know the market. First you have to know any trading systems, trading styles, trading instruments, because there are plenty of them. Very much information, and you have to learn basics of trading. And the second group is competent trader. In this phase, and the second phase is building competence. In this phase, the trader has to develop discipline and ability to execute upon chosen trading style. You already know what do you want to learn, and you have to eliminate mistakes and learn to focus on the right things. As you already know what to focus on, you know the market you want to be involved in, you can search for a specific education from an expert trader in this field. For example, you can join some trading chat or virtual trade room, or you can receive specific education on the preferred topic. For example, you know that you want to master trading with market profile, being a swing trader. That's why you would not learn scalping. Of course, you can have several trading methodologies at your disposal, but first you have to master something specific. And the goal of this phase is to learn to stay in the game. When you are able to at least cover your costs, it is already a competent level. But of course, it is not yet a desired level of performance, which is the third one. It is the phase of expert trader. In this phase, trader has to develop his or her abilities to make good decisions, working on psychological issues, and filtering some bad trades by anticipating market action. In previous phases, trader is more focused on his or her own actions, building discipline, doing the right things, while in the phase of expertise, trader can already focus more on the market and anticipate the market action. And only in this phase, trader can set financial goals. That's very important, because in previous phases, goals have to be connected with the process, but not with financial result. And now I am going to tell you a small story. Once upon a time, I had a desire to develop not so active trading style that could have helped me generate enough profit for making a living traveling. When you travel, you often have bad internet connection. At that time I was traveling in Asia, in Thailand or Bali, and internet connection was not so good sometimes. And I've heard that selling options is almost passive strategy that can generate consistent profit. I'm not talking about binary options now, I'm talking about traditional options. In a nutshell, if you sell an option, you receive predetermined profit, that is premium, in case market doesn't do anything. Around 80% of options expire worthless. It's official statistics. So I've decided that I want to sell options because I don't have good internet connection. So I have ability to enter the trading terminal twice a day. So I have decided to do that. Before that moment, I had enough experience in day trading and swing trading, and possibly had achieved level of expertise in what I was doing. And the first mistake that I have made is that I have passed through education from possibly an expert trader. I don't know whether he was really an expert or not, but he operated mathematical formulas that I didn't fully understand. I just wanted to copy his strategy. I wanted to copy his actions. And this is mistake number one. You cannot take someone else's strategy and copy it without knowing all fundamental principles, without foundation. Well, you can do it for some period of time, but it's not enough to build successful trading, to build successful strategy. And what could be better done in this case? First of all, I would have taken a couple of books on this topic and reread it. While I had some theoretical knowledge on this topic, I possibly needed some paper trading. I would better watch prices of options in real time and observe how they change. It would give me real experience, it would give me a better vision of what I have to do in this market. And the second mistake, and very rough mistake, is that I haven't had a plan for worst case scenario. If you're familiar with options trading and options selling, you have to know that there is no stop loss there. Risks are managed through delta hedge. Profits are limited for such kind of trading style, and losses are potentially unlimited. Yet in any type of trading, first we have to manage risk, and only after that we can think of return. In reality, we cannot manage return, we have to manage risk. And options trading is not an exclusion. That's a very rough mistake. That's a very bad mistake not to think about risks. And of course, market is ready to teach us when we do such kind of rough mistakes. When I had sold an option, market had rapidly rallied to the upside. I had sold a call option, and my call option started immediately to generate loss. I consulted with my mentor. He said that it is okay, that is sort of a norm, we have to sit on our loss. But eventually I had some experience in momentum trading, and I have decided that market is pretty strong trading. Market is in strong trading condition, and if I hold this position I can generate more and more losses, so I was wise enough to close this position. That was a very good decision because market had rallied even higher, and if I hadn't closed my position I could have lost more than 50% of my account. That time I have lost around 15% or so it was pretty manageable loss. It was not a catastrophic loss. I stayed in the game, which was very good, because if I stick to a losing position I could have lost very much money. Mistake number 3 is that I risked too much before getting to at least competent level in a chosen trading strategy. Before we decide to take additional risks, before we decide to trade aggressively, we have to reach the level of competence, which means that we have to observe this market, we have to gain more experience in this trading style, and only after that we can decide to take additional risks. This time market had taught me these valuable lessons, and I was fortunate enough to accept these lessons quickly. I have closed my account, and 2 months after that broker had gone bankrupt. Market had taught me a valuable lesson once again, and I was fortunate to accept it quickly, as I have said, and I am grateful for the market. The lesson is that you can't become an expert before getting knowledge about fundamental principles of your preferred trading style, even if you are already good at any other trading style. So first you have to become competent trader, then you can build an expertise. Now let's talk a bit about level of competence. The goal of this phase can be described with what I call the Godfather principle. First survive, then prosper. And the goal of this phase is to learn to survive, to learn to keep the capital in the game, not to lose the capital. It is not an easy task, and it is not an easy phase, because you will have to learn many things, and better to say, you will have to learn to stop yourself from doing many things. You will have to learn not to move your stop loss, not to catch tops and bottoms, not to overtrade, and not to do many other things, and it is not an easy task. There are many challenges and issues to work on when you build competence. The first and very common issue is to learn to set initial stops and not to move it. It is very common behavior among traders. They violate their own risk management. Even if they know on a logical level that stop loss will protect their account from bleeding, they tend to hope that market will get back to at least their entry point. So it has nothing to do with professional trading and profitable trading as well. While you can do this several times, eventually it will destroy your account. So it is issue number 1, setting stops and not moving it. Of course I am talking about initial stops, because if you have already profitable position you can move your stop, but it is a wholly different process. In this case we're talking about position management. And of course you can move stops, protecting your profit. Then you will have to rewire your brain and get rid of catching tops and bottoms. I paid some attention to this topic in previous webinars, but I want to stress it once again. It is very much easier to trade in the direction of the trend than to capture a reversal, even if price seems to be too high or too low. You will also have to learn to keep your trading within predetermined risk limits. That is also very important. And finally, your goals have to concern process but not the financial results. For example, you can have such goal as improving your patience for 20% or something like that. You can measure your success in following your trading plan. Imagine that you have a supervisor that is going to pay you some salary in case you follow your trading plan, but not in case you earn any money. That is difficult for retail traders, but that's what we have to develop. Besides, it is much easier to do for professional traders working in hedge funds or banks, because they will receive salary regardless of short-term financial results. Of course, they also receive bonuses by the end of the year, but they don't have short-term expectations. They don't have to make a living with their profit. That's why retail traders are under much greater pressure than professional traders. And we have to learn to grade our success by following our trading plan but not earning short-term profit. Now let's talk about the tools for self-coaching within this phase. I would first recommend to work with a playback tester. For that purpose I use special software, but you may use inbuilt features of your trading terminal. Market is changing pretty slowly, and you can trade on demo account, of course, which is good decision for beginner trader, but it will consume much time before you will make enough trades. And you can accelerate this process trading on a historical chart when you have accelerated speed of price action. It is like using a simulator for pilots or athletes. And when you put enough time for such kind of training, you will remember many patterns. They are going to become unconscious. For example, you will be able to see that every time you try to catch a bottom or a top, you get stopped out. If you do this 100 times on a simulator, you will of course avoid it in real trading. Then of course you will have to journal. You will have to journal since the first day of your trading, and the earlier you start to journal, the better. But trading journal, as you already know, is not just a trading log. It is a journal when you describe your feelings, your thoughts and expectations about the market, about your trading, about your current trade. For example, if trade was psychologically easy to execute, it was possibly not very good trade. And then you compare your financial result of the trade and feelings before the trade, and maybe you will not get in such a trade next time. And you can also join chat rooms or virtual trading rooms with fellow traders. It will be better possibly if you know these people, and sometimes it is beneficial to create a work chat with a couple of colleagues and to exchange ideas in the market. Of course you will have to follow your own view, but sometimes it is good to hear somebody's opinion on the market. And finally, you can set weekly process goals. We will not talk much about level of expertise. I would only say that it can be best described with what I call the Bruce Lee principle. When there is an opportunity, I don't hit. It hits itself. And it is a state of mind when you don't have any expectations about the market. You don't even want to get in a trade, but you are ready to respond when your setup appears on the chart. And in this webinar I want also to talk a bit about discipline, because too many times traders claim that they would have become good traders if not issues with discipline. Is it really so? Many traders and many people have different opinions on this topic, yet there are two major approaches about discipline. Some traders want to have external risk management, and they say that they need much effort to keep their greed and fear under control. Sometimes they need automatic risk management tools that will stop their trading once certain loss limit is achieved. I would say that it may help achieve short-term results, but in the long run it may bring some problems. And if you force yourself to do something, eventually you may break. In trading, it means that someday you will find yourself violating your own rules and having really bad performance, really bad day. Imagine that you have spent a month forcing yourself to observe some rules and you were successful doing that, you have earned some profit. But emotional pressure is not gone. When you release some of your self-control, emotions can overtake your actions. And to achieve long-term results, it will be much better if you develop self-awareness and emotional intelligence. Self-awareness is a state of mind where you can recognize your feelings and emotions and not let it interrupt your vision. When you are able to recognize and accept your feelings, your view will become much more clear, and you will not have to force yourself doing anything. You will act in your own best interest. Acting in our own best interest is a natural kind of behavior, and if we have decent level of self-awareness and emotional intelligence, we will have better odds of not doing destructive things. Here is a formula. Logic drives our thinking, emotions drives our actions, and actions drive our performance. If you don't manage emotional component, you may start to fight yourself, to force yourself doing what you need to do. And sometimes thoughts lead to emotional reactions. Sometimes emotional reactions appear as a response to losses, like feeling of frustration or anger. But the more dangerous thing occurs when emotional reaction pushes some unconscious trigger for unwanted response. You can't even recognize it, but you may have automatic patterns of behavior that could have helped you solve some problems in the past, but now they are outdated, if not, say, irrelevant for trading. Here is a list of most common actions that can be triggered automatically. It is first of all fear of missing out a trade. This term describes behavior of people who are involved too much in social networks. They check their Facebook page all the time, they think that they can miss something important. And the same is with trading. Traders can also watch charts over and over again and finally get in a trade, being afraid not to be in the market. They think that big move is underway and they have to have long or short position. Then it is moving stops, of course, and taking profits too early. It can be also overtrading, which is often an attempt to create action when market lacks volatility. Nothing happens, but eventually trader finds himself or herself overtrading, trading too much in a market that doesn't generate any good opportunities. And finally, trader can get married on a trade. Position which is not good anymore can be held just because of previously built expectations. Because we had expectations before and we are very uncomfortable closing this position. Because we are not just closing this position, we also get rid of our expectations, get rid of our hope of earning big profit. When you increase your self-awareness and your level of emotional intelligence, you automatically increase your number of ways of response. Instead of automatically responding to emotional state or behavior of the market, you can choose your response. It is considered to be a proactive way of behavior and it requires much self-awareness. Because if you choose another way of response, you can get another result. Instead of fighting the market, instead of making destructive actions, and instead of getting yourself in a bad position. And finally, how to increase your level of self-awareness and emotional intelligence. First, you can develop a habit of fixing your thoughts and emotional states in a journal. Traders pay too much attention doing their market research or reading analytics, but pay too little attention to their own feelings. If you develop a habit of writing down your feelings and thoughts before your trading day starts, you may notice that it becomes easier to do what you expected to do. you will have less pressure and you will have nothing to fight with. Then, if it is possible, you can speak out loud. What do you feel right now? When you do this, you move away from your emotional state and you anchor yourself in a neutral position. Then you can make a list of your triggers. When you know your typical behavioral patterns, you can anticipate them and prepare. And when something happens in the market, you will not be caught and you will be ready to break automatic response. So if you know how you typically behave, you will be prepared and you will not be caught by immediate response. And finally, you can transition to another time frame. That's the last thing. Sometimes day trading is too difficult for many people and they need to reduce activity. Sometimes it helps, but it is not the only solution because your behavioral patterns are not gone anywhere. They can appear even if you trade on long-term charts, on daily charts. So, nevertheless, you will have to increase your self-awareness and emotional intelligence. That is out of the question. Thank you for watching this video. In next webinar we will continue talking about self-coaching. I hope that this video was useful. If you have any questions or comments, feel free to leave them below this video. I will do my best to answer all of your questions. Please be specific to receive a good answer. See you in the next video.